Hello, class. This is a brief lecture on accounting cycle basics. I like to do this in the AIS class in the early days because we're going to have to work the cycle to gain a good understanding of the accounting information system, the needs of that system, the inputs, the processing, and the outputs. And when I do this in a face-to-face class, we actually take a diagram, an illustration of the system. I'll show you a depiction of that in a moment. I asked the class to write an article or write a paper, quick paper on it. Nothing research oriented, just a reflective piece or a descriptive piece, as if they were trying to explain the system to a friend who doesn't know much about accounting. And I would kind of hold my online classes to that kind of standard. Could you explain, at least ask you this question, could you explain the accounting cycle to someone who doesn't know much about accounting? But anyway, let's talk a little bit about the basics. To understand amounts appearing on a company's balance sheet, it does help to understand the processing that went into that, generally accepted accounting principles, these different rules that we work with. However, what I'm going to talk to you about right now is not so much about GAAP as it is just working a basic process and understanding the different parts of that cycle. I like to start with the balance sheet because I think the balance sheet and the balance sheet equation is a good framework for understanding transactions. Now, there's all kinds of transactions that can happen in a business. The transaction is some type of event that the business is involved with. But what is truly an accounting transaction are business activities that cause changes in the balance sheet. So you have to, in order to really understand transaction, which is like the foundational piece of the cycle, you have to understand how specific activities will affect the balance sheet. That's why we ask students to track these things, these different business transactions in our accounting classes. The cycle looks like this, and you start up at the top here with the journal entries. And making a journal entry involves having to analyze a transaction and just actually asking yourself the question, is there a change in the balance sheet because of this transaction? Meaning, was an asset account impacted? Was a liability account impacted? Was there any effect on owner's equity? When I teach this in a fundamental class, when we start in the processing of transactions, doing our debits and credits for the first time, I make my students really hang on to that accounting equation. I make them write it down in front of them, or use one of our prior handouts that have that formula listed on the sheet, and say, stare at that formula and figure out if this transaction has any change, makes any of those accounts change. Anything in that, anything in that asset category, anything in a liability category, any of those accounts in equity. So the journal. And in the class, you're going to be working with journals. You're going to work with a journal in the, the Cybertext project. You're going to work with them again in the Systems Understanding Aid project. The journal is the original entry point into the system. And it's chronological. You'll be doing your journals by date. It's almost like a diary. It's a good analogy, business diary. But again, the only thing that's going to go into the diary, so to speak, are those events. We're going to be recording those events that impacted the accounting equation. Once you journalize, you post. Know the difference between journalizing and posting. You post to ledger accounts. In our first project, the Cybertext project, you're going to be posting to general ledger accounts. In the second project, you'll be doing a lot of posting to what are called subsidiary ledgers. But the accounts are where it's at. I mean, we've got to get those accounts updated because of transactions. So we document the transaction in a journal. We post the accounts. We post to the ledger to bring the accounts up to date. Again, I want to repeat myself. Know the difference between journalizing and posting. At some point, you prepare an adjusted trial balance. Now, I say at some point because unadjusted trial balance. I say at some point because I don't want to make a rule here that, excuse me, that the trial balance has to be done every single day, but certainly many businesses with a lot of activity will do it each day. They will do it each day. Some might do it once a week. Some might do it. I have a side business. I wouldn't need to do it probably once a month at most because I don't have a lot of transactions. Very small, almost inactive business. Not inactive. I mean, I have transactions, but they're few and far between because my service is consulting work and I can't do a lot of that during the semester. So I wouldn't have to do a trial balance very often. But my local credit union, even though it's a relatively small credit union, has hundreds of transactions every day and they need to do a trial balance every day. A trial balance is a type of internal control, the preparation of that, because it's going to make you stop and take a look at things to see if you have quality in your general ledger, that your debits and credits are equal. We'll talk more about that later. Once a trial balance is done, adjusting entries have to be made. And then you go on and prepare an adjusted trial balance, which is very similar to the trial balance, but it is just after adjusting entries have been made. Now, we were talking about adjusting entries in class recently, and a student confused adjusting entries with closing entries. And it's easy to confuse the two because they both involve sort of housekeeping work. You adjusting entries are going to bring your general ledger up to date. Closing entries are going to do the same thing with certain accounts, resetting the values to zero in the temporary accounts. Adjusting entries are really to fix up account balances, but when I say fix, I don't want to define this as fixing errors, because many times adjusting entries have nothing to do with errors. They are there, they have to happen because many times the passage of time and the fact that there are some unrecorded transactions, unrecorded economic events that we need to take care of. So, for example, if you haven't had a chance to bill somebody yet, but you provided the goods and services, there's a good chance you need to make an adjusting entry to revenue. If you haven't calculated depreciation in a while and recorded it, good chance you're going to need to do adjusting entries. So you're tweaking your revenues, you're tweaking your expenses, you're trying to get a more accurate gauge on net income with a lot of these adjusting entries. But it also sometimes has an impact on account balances in the asset area and in the liability area. So I like to think of it almost as a checklist. If the business has been operating for a while and the accountants know what they're doing, they'll have a checklist of things that need to be looked at, accounts that we need to examine to figure out if adjustments need to be made. We want to do that before we move on to do the financial statements. You see, another trial balance is prepared after adjusting entries. If the debits and credits aren't equal, again, it's quality control point. You'd want to stop and go back and look at your adjusting entries and make sure those were done properly. Move on to financial statements. The preparation, or as the accountants would say, compiling the financial statements. Know the basic statements, the income statement, the balance sheet, statement of owner's equity, the statement of cash flows. Please know the order, the proper order of these. In other words, if you had to do these manually, if you had to just sit down and do them in Excel or on a piece of paper, and you really didn't have the aid of software other than maybe Excel, would you know what order to prepare these? The order is like this. Income statement first, statement of owner's equity next. Next, you'd do the balance sheet, and finally you would do the statement of cash flows. And the reason for this is there's information flows between these reports. So the net income is needed to figure out current position of equity, retained earnings in other words. Equity is needed in order to prepare the balance sheet, assets equal liabilities plus equity. And then all that information will come into play to help do the cash flow statement. One thing we talk about in class that you might miss out a little bit on the online version of this class, we talk a little bit about the audited financial statements, the importance of audited financial statements in some settings. Certainly your 10K of Apple, that assignment, you probably examined the letter from Ernst & Young, or the two letters from Ernst & Young that have to do with the audit of the financial statements and the audit of internal controls. I would think as an accounting student, you want to know the importance of an audit. You know, that idea that these financial statements are fair and accurate, and we want to get an opinion from an independent third party, an auditor, an external auditor, a CPA, certified public accountant, blessing these. In other words, saying these were done properly, these financial statements. Then you move on to closing entries, and closing entries occur at the end of an accounting period to do two things. One, set to zero what are called the temporary accounts, the revenues, expenses, and dividends. You want to set those accounts to zero so that the next period they start at zero. We have an underlying assumption in accounting that our revenues and expenses reflect what went on during a certain period of time. And if we're moving into a new period of time, a new year, for example, those accounts, the revenues and expenses, need to be set back to zero. The other goal of closing entries, so to speak, is to update retained earnings. So in closing out the revenues and expenses, zeroing those out, we transfer these dollar amounts, these amounts in these accounts, over to the retained earnings account. So we'd increase our retained earnings by net income, decrease them by net loss, and we'd also decrease retained earnings by the amount of dividends that were declared during the period. Then a post-closing trial balance is prepared, which would include only the permanent accounts, the assets and liabilities, and the equity accounts. Those balances carry forward to the next period. Also, I want to go back here for a moment to adjusting entries and make sure that you understand that with adjusting entries, you do have to do journal entries and post to ledger accounts. And the same thing with closing entries. You have to journalize those and post those to the general ledger accounts. Here's the balance sheet equation, which is the foundation for transaction analysis. When you do your journal entries, you want to first contemplate the impact on this equation, the elements of this equation. You want the impact on the elements of this equation as a result of a transaction. You have to be able to ask yourself, is there any change in the economic resources of this business that are owned? These probable future benefits that are owned by the business. Any change because of the transaction? Is there any change in the liabilities, the debts and obligations of the business? Anything that happened there to increase the debts, increase the obligations, or to reduce those? Is there anything that happened because of a particular transaction because of stockholders' equity? We have to look into that. We have to look across. I work left to right when I'm teaching this, and when I'm trying to figure out a transaction, I work left to right. I ask myself, any assets involved here, any liabilities involved here, any changes in stockholders' equity involved here. And if the answer is yes to those questions, I've got myself a transaction, that has to be recorded. Transactions can also involve internal events. Certainly external events are probably more easier to relate to. Exchanges between the entity, meaning the business, and one or more outside parties, like the purchase of a machine from a supplier. Certainly a transaction is there, needs to get into the accounting system, get it into the journal. There are internal events that are not exchanges between parties but do have a direct measurable effect on the entity. In other words, there can be internal events that change the elements of the balance sheet, change the assets or change the liabilities or change the stockholders' equity, such as using up of insurance paid in advance. Other examples are depreciation. Other examples are the interest earned or interest that we have expensed, should be expensed during the period. Accounts are the focus of the system. In other words, the ledgers, are where it's at. I said that before. Some type of standardized format is used by companies to accumulate the dollar effects of transactions. This shows like little folders. In accounting 1, you use T accounts. In this course, we will eventually use some standard ledger type accounts with running balances in them. This is just something some of you might find helpful. You might remember this from accounting 1. I like to include that here. I'm going to just, I'm not going to go through this, but if you wanted to pause this audio, this YouTube video and read this, you might find it helpful. I tell my students it's a pretty decent list. But what you're going to find is that in our projects, there's going to be a chart of accounts. We will have to use a chart of accounts. And it would be good for you to look at these chart of accounts before you process your transactions. Here's some basics that will carry over from principles or intermediate, but I like to use these as refreshers because before we go into this project, we've got to be up on our principles of transaction analysis. Remember, every transaction affects at least two accounts. So number one, really, the transaction is truly an accounting transaction if it has an impact on the accounting equation. Number two, every transaction affects at least two accounts. That's called duality of effects. That's an underlying assumption of accounting. Double entry accounting, it's sometimes called. The accounting equation must remain in balance after each transaction. This says after each transaction. It's after each transaction has been recorded and posted. The theory is this should still be in effect, that assets are equal to liabilities plus stockholders' equity. It could be that the assets went up by a certain amount and went down by a certain amount. The formula will stay balanced. It could be that the assets went up by a certain amount and the liabilities went up by that same amount. And then that transaction would result in this still being balanced. Okay. This is PowerPoint from Principles of Accounting 1. Another question you could ask yourself, what was received, what was given in a transaction? Identify the accounts by title. Be precise in your thinking. For example, supplies are different than equipment. Office equipment is different than computer equipment. You have to look at your chart accounts, refine your thinking, don't be lazy with it. Inventory is not the same as supplies. There's an inventory account and a supplies account. They're not interchangeable. They're not synonymous. It's almost like we all need to have kind of a decent definition of every account that's in the general ledger. If you don't know what an account title means, then you should ask me or email me or look it up. It helps to be able to classify every account by its type. Is it an asset, a liability, stockholders' equity? Kind of already went over that. But here's a tip. Your chart of accounts should be in that order. Should be assets, liabilities, equity. The revenue should be bunched together. The expenses should be bunched together in that chart of accounts. Determine the direction of the effect. Did the account increase or did it decrease? And of course, for you guys in my class, you've got to match those pluses and minuses up with debits or credits and debits. You've got to be able to match them up. If it's an asset, for example, and it's increasing, it's a debit. But if it's a liability and it's an increase, it's a credit. You got to know your debit and credit rules. If nothing else, have a cheat note in front of you when we talk about these things. And then, we talked about this before, is the accounting equation in balance? Meaning after you have processed the transaction, could you make the case that your formula of assets equal liabilities plus stockholders' equity is still in balance? In other words, that equal sign is still correct. Companies keep their balances in a general ledger. We teach it using T accounts. The general journal, though, is the starting point. This is just simply a review. That's the starting point. You journalize transactions, you post to the general ledger. T accounts are used in fundamentals courses. We use different formats than T accounts in AIS. So there's the cycle. Here's a slide with the cycle in steps instead of depicted in a drawing as I showed you earlier. I'm not going to read through this. If you want to pause and read it, that's fine. Disseminating information down here to users is important. What I'd like to add to is, for some companies at this point, those statements need to be certified by public accountants. An opinion issued as to whether they were done properly. That's an external audit. This is sometimes helpful to carry over. Don't ignore these chapter numbers. These are not relevant for our course. But this is another format that's like a cheat note that some students find helpful when processing transactions. This is a review of the format of a journal entry. You always start with your debit, followed by the credits. There's the name of the account. You don't need these pluses in here, but the name of the account There's the debit to cash. There's a common stock account, the credit to common stock, additional paid-in capital. This is just showing you how this is supposed to be laid out. In our second big project, which is the SUA one, Systems Understanding Aid, believe it or not, we don't use this format very often. This is what's called the general journal format. You do use this in the Cybertext project, and it's kind of templated out for you in the Excel worksheet. In the SUA project, we use what are called special journals, and I have more information on that online, and you can reference that when you get to that point. It's also well documented, the formats of journals that we'll use there. But this is good. Whoops, I went ahead too far. You will need to use these in some cases in the SUA project, in other words, general journals. But they'll be reserved for odd or abnormal or not very often type transactions, adjusting entries and closing entries. Here's a little schematic on posting, just to emphasize this idea of here's the journal, the original place where the transaction is entered. And look at the elements of this. There's account names, and this right here is a description, just simple description, investment by stockholders. Or it could be shares issued to stockholders. There's nothing official about that description. It just adds a little bit to the audit trail. These reference numbers that you see in this journal are cross-referencing the ledgers. So cash is posted to account number 101. It's very common for accounts to have both a name and a number, a unique number. So this references, so 301, that credit was posted to 301 right there. And it came from the source information that it came from was a general ledger, G1, page G1. So journalizing, posting. Journalize, post. Journalize, post. Here's a little blurb on the trial balance, which I showed you earlier. This is from the Accounting 1 textbook, but it's a good memory jogger for you. You might recall seeing something like this. Look at what a trial balance is. Listing of accounts. There's the balances in those accounts as of that particular day, March 31st. The total debits, down bottom, he just total the column up, total credits. These numbers are in thousands of dollars, so you'd have to add 3 zeros to all these to get the correct number, so to speak. But trial balance is a listing of the ending balances in each account in the general ledger. The purpose of the trial balance is to make sure that the debits and credits were equal before we prepare the balance sheet. Actually, before you do a trial, before you do adjusting entries, you do this. You do it again after adjusting entries, just before you prepare your balance sheet. And you actually prepare something like this after closing entries. That's all I have for now on this. Just a quick intro. I hope it was helpful for those of you that are a little bit rusty on the accounting cycle. And if you do have any questions, please let me know.